So I made this slideshow because I wanted to be able to have the students have a basic introduction to accounting terms and principles. If you are in this class at Vista Adult School, you may not have taken this accounting class yet. So if you have, then you will probably already know everything that's in this basic terms slideshow. I use this at another school. I used it to teach the basic terms and we practiced it, but we won't have time. I'm just going to go through the slideshow and hopefully this will help you learn the principles that they refer to in the QuickBooks class. Okay, so we're going to start. And I wanted to start out with what kind of job can you get if you learn accounting? And I wanted to tell you the difference between the different jobs. So if you're accounts payable specialist, that is a person that only pays the bills. The people give you the bills and you write checks and you pay them, or sometimes you could pay them over the internet. There's an accounts receivable clerk. That means people that owe you money. You take in the income that's received by the company and you credit the people that they charged. And you also bill people when they make sales. A bookkeeper is a step up, although this term is used loosely, interchangeably. But it usually connotates somebody that knows accounting terms and principles. If you're an accounts payable specialist or an accounts receivable clerk, you actually could get away with doing the job if you didn't know the accounting terms. But if you were a bookkeeper, they would expect you to know the terms. An accountant is somebody that has to have a degree in accounting, and they have to do an internship in an accounting firm and pass the CPA test, Certified Public Accountant. So obviously they make the most because they need a degree, an internship, and that's what they need in order to be called an accountant. Well, in order to be called a certified public accountant, a CPA. Sometimes people call themselves an accountant if they don't have a CPA, and that actually is acceptable. And there is a payroll specialist. It's somebody in a company that only does payroll. So this person doesn't have to have a degree. They could learn the job by someone training them. And they actually don't even have to know accounting principles unless something goes wrong. An accounts payable specialist, accounts receivable clerk, and payroll specialist, they actually don't have to know the terms unless something goes wrong, but usually then they ask their supervisor. But a bookkeeper and an accountant can make corrections if something's wrong in an account or in a bank, in a bank account or in a general ledger, they're able to fix it. Okay, so in the old days, which actually was when I started accounting, we were still doing it on paper. We would write on ledgers and then we would transfer it to other ledgers and then we would total it with an adding machine, the picture of the adding machine, and then we transfer it all over to financial statements. So it took a long time. When I started, it was probably 40 years ago. I had a staff of 8 just to do all those things. I had an accounts payable clerk, receivable, payroll specialist, just to handle everything. Towards the end, when I was working in business, I became a teacher about 12 years ago. So I had just come off working in business for 25 years. But I was using QuickBooks because it came in the 80s. And it was only me and a part-time assistant because everything was computerized and we did everything probably even better than when I had 8 people because QuickBooks doesn't make errors, but that's how we did it in the olden days. So now I told you there's computer software, and you could see by this person, she probably does a lot of it. Like I was the head person, I was called the financial manager, but I did entries and I paid stuff, and my assistant basically did bank reconciliation, and the accounts receivable, I think that she did, but we shared it. But I did a lot of it just because in one entry in QuickBooks, if I entered the customer name, I entered how much they owe, or if I entered a vendor name, I enter how much they owe, I write a check, that's on the computer, it puts it in an envelope, it does it all in one step. And when before, it took a long time, even you had to write manual checks. So that's what modern bookkeeping, the technology, the program QuickBooks is the one that makes everything go really quickly. Okay, sorry. Okay, now in accounting software, now this has also been since 2000 years ago. You had to have debits and credits. But in accounting software, it forces you to make the debits and credits because the debits and credits have to match each other. They have to balance like a scale. So the electronic accuracy eliminates the errors that happen when we did it manually. So the debits will always equal the credits. So you are expected to know double entry bookkeeping when you learn accounting principles and terms. And what the double entry means is that every transaction will involve at least 2 accounts. And they have to balance each other. They have to be the same amount. So let's say you went to the store. No, say you went to buy a car and you paid them out of the checking account. Well, your checking account goes down. Let's say the car was $30,000. Your checking account went down by $30,000, right? But your assets, which you'll learn what it is, an asset, the car account went up. So you always have to have 2 accounts. You can't just write a check and not say, where did the money go? That's called double entry bookkeeping. Double entry bookkeeping means it always involves 2 accounts. And you cannot debit the same account. You can't debit cash and credit cash because that is 0. So you always have to have 2 different accounts. So what have we learned so far? What does double entry bookkeeping mean? I just said it. It means 2 accounts are always involved. So let's see some examples. Say you have a company and you sell a product, you sell widgets, and you borrow money to start up your business. Well, your cash goes up because the bank gives you money, right? But your loan payable also goes up. So let's say you borrowed 10,000. Now your cash went up by 10,000, but because you owe the money, your loan payable goes up by 10,000. So let's say you pay your rent. Your cash, say it's $2,000 a month. Your cash goes down by 2,000 and you debit your rent expense. Your rent expense goes up by $2,000. Okay, let's say someone came in and wanted to buy your widgets on credit. They came in and they said, hey, could I have 20 widgets, but will you bill me? So we talked about accounts receivable, right? That means people owe you the money. And so that goes up because now he owes you, let's say it's $1,000 for 10 widgets. So you have accounts receivable, think of it as like an IOU. So this person that came in owes you $1,000, and your sales goes up. Your sales account, it goes up by $1,000 because that's how many sales you made, right? You made $1,000 in sales. Okay, let's say you go out and purchase goods on credit. So let's say you needed office equipment and your computers cost $30,000. So you have, well, oh, inventory. Well, you have $30,000 in your inventory of equipment, right? So your inventory of equipment went up by $30,000. However, you didn't pay for it. You owe the person, let's say you bought them at Best Buy. You owe Best Buy $30,000. So your accounts payable, an accounts receivable is an IOU where someone owes you. An accounts payable is an IOU where you have to pay them. So you owe them $30,000. And let's say, okay, now the person that said, oh, will you give me the widgets on credit? He comes in and he goes, here's the $1,000. I want to pay my bill. And so your cash goes up, right, by $1,000. But your sales did go up because you didn't just make a sale. He just paid off a bill that he owed you. Your accounts receivable that he owed you goes down by $1,000 because he owed you $1,000. He paid you $1,000. Now he owes $0. Now at the bottom, I put, don't worry if you don't understand this. This is just the beginning. And even at the end, I'm going to go so fast on here. This is just to give you an overview of accounting terms and principles. Okay, so I use the term debits and credits. And if you could see, it's been associated with double entry bookkeeping for more than 500 years. Oh, I thought it was more than that. I thought it was like thousands of years. But here's the meaning. You got to remember this. Debit just means left. It doesn't mean go up. It doesn't mean go down. It only means left because a debit will always be on the left side. Now, sometimes debit will mean go up and sometimes debit will mean go down, but it doesn't always mean the same thing. But you can always rely on that debit means left. Credit means right. So you can always rely, if you see credit, it means it goes on the right side, okay? So if you look at the hands at the bottom, the left hand is the debit and the right hand is the credit. Okay, so let's review. We've learned a little bit more. So does debit mean to increase? Well, no. Sometimes it means increase, sometimes it means decrease, but it does not always mean to increase, okay? But what does debit always, always, always mean? It means left, okay? What does credit always, always, always mean? Credit always means right. So debits and credits always have to equal. If I have $1,000 credit, I have to have a $1,000 debit, okay? Because otherwise your books will be out of balance. It's like if you have a checkbook and I hope you guys balance your checkbook, but it's like if your checkbook doesn't balance, then your books won't be balanced if your debits don't equal your credits. And to be honest, the software won't even let you get out of balance. It will say, hey, you made a debit. Now you need to make a credit. Won't say it exactly like that, but basically that's what the message will say. And debit is abbreviated as DR. I do not know why, but it is. I didn't make that up. That's just conventionally DR means debit, and CR means credit. And you could see by the scale, they have to balance. So for each and every transaction, the total amount entered on the left side of an account has to equal the amount on the right side of another account, not the same account. Remember I said you can't debit and credit the same account. So let's say I bought the car. I credited my bank account. Credit means makes your bank account go down, but it's on the left side. No, it's on the right side. And I debited my automobile account on the left side because it's an asset. So I debited automobiles and I credited my checking account. So for each and every transaction, the total of the debit amounts must be equal to the total of the credit amounts. The reason I put that was because sometimes you have what's called a split entry. Let's say you went to Staples and you wrote a check for $3,000 and $1,500 of it was for a computer and $1,500 of it was for office supplies. So you would debit your office equipment for $1,500 and debit office supplies for $1,500. That equals $3,000, right? And the check was for $3,000. So you would credit your bank account for $3,000. So you see, even though this was two entries on the left, they still balance. Okay, so we're going to talk about T accounts. This is how you learn accounting. If you already took it, you knew this, but it's just a temporary way to record information, and it's also a way to teach accounting. T accounts are used to teach accounting. So what you do, it's called a T because it looks like a T, a vertical line and a horizontal line. And there actually is a video, and it's in the resources, the student resources section in this Canvas that I encourage you to watch if you haven't taken accounting. And she goes more into detail about how to use T accounts. And it's a pretty good video. She did it manually on a Blackboard, but it really explains the concepts. So here's the T account. And you could see there's a title at the top. It would be like automobiles or bank account or whatever the account is. And the debits go on the left side of the T account and the credits go on the right side of the T account. So remember I said you can't debit or credit the same account, because let's say this was your bank account. If you debited it by 1,000 and you credited it by 1,000, that would be zero. There wouldn't be a purpose for making that entry, right? So you always have two accounts involved when you use T accounts. So you could see we're using rent expense and cash. Cash usually means a bank account. Could be a checking account, could be a savings account, but in accounting, they just refer to it as cash. So we recommend that it says here, they recommend you draw two T accounts. And when we pay the rent, we debit the rent expense account, and that goes on the left, and we credit the bank account because we wrote a check. So we have two accounts and the debits equal the credits, okay? All right, so we're going to start with definitions now. There's three main accounts that I'm going to talk about now. And there are more than that, but these are kind of broad encompassing definitions. An asset is property that the business owns. It could be a building, a bank account, an accounts receivable, money that people owe you. It could be a car. It's any item that the business owns. And an accounts receivable, I call that an item. So an asset you own. A liability is what you owe. It could be a car loan. I owe the bank the money for the car loan. It might be that you owe payroll taxes because you took them from the employee and you have to give it to the government. So it's not your money, you owe it to the government. It could be a mortgage, a loan on your building that you have to pay to whoever you took the loan out with. So liabilities are what you owe. Capital is your equity in the business. If you sold all your assets and you paid off all your debts, that's how much equity you would have in the business. So let's review. Now, don't worry, I'm going to give you an example about assets, liabilities, and capital, but we're going to talk about what terms did we learn? What means what you owe to somebody, like a loan? Liability, right? What term means what you own? That means asset, right? Good job. And what is your equity in the business called? Capital. Okay, I'm going to introduce the most used equation in accounting. This is like the foundation for accounting, and we're going to build on other things, but it all boils down to this equation. The equation is assets equal your liabilities plus your capital. With double entry accounting, the equation should always be in balance. You can't have this side equal 50,000 and this side equal 60,000 of the equation. If this side equals 50,000, then the right side has to equal 50,000. Let's see. So I'm going to give you an analogy. This is not a business, but this will help you think of assets equal liabilities plus capital, okay? So let's say you bought a home and the home costs $500,000 because as you'll learn in accounting, you register the asset for what you paid. You do not register for how much it's worth. In accounting, you always register what you paid. So your asset is a house, right? And you have a mortgage, which is a loan, right? So you bought the house for $500,000 and you took out a loan because you didn't have $500,000. You only had enough for the down payment. And so you took out a loan for $400,000. How much equity do you have in your home? So here's the equation. You have $100,000 in equity. And that's probably, if you did this equation right when you bought the house, then your down payment was probably $100,000. And that is actually a very common down payment amount because homeowners very commonly put down 20% and 100,000 is 20%. So now, if you look at the bottom, do you see the equation? Asset equals liability plus capital. Now, capital equals the same as equity. So the asset, the house, 500,000, equals the liability, which is the mortgage, 400,000 plus capital, 100,000, or your equity. You have $100,000 equity in your home. Okay, so remember I said that debit sometimes means go up, debit sometimes means go down, right? It's because for different accounts, a debit means go up, or another account, a debit means go down. So if you look here, see this assets? For assets, debit means increase. And how can I remember that? Well, assets is on the left side of the equation, right? And what does debit mean? It means left. So I know in my head, and I kind of just have to memorize it, but debit means, now there's formulas to help you, and there's a video, this guy, how he remembers everybody. You have to kind of think of your own way to remember this. But you have to remember that for assets, to increase the asset, you debit it, okay? So you have to just remember that. Or you could think, well, which side of the equation? It's on the left side. Liabilities, credit means to increase. So if I credited a loan, it meant the loan went up. You owe more, okay? And how can I remember that? Well, what does credit mean? It means right. And liabilities is on the right side of the equation. So for liabilities, credit means to increase. For equity, which side of the equation is it on? It's on the right side. So it has a credit balance. So credit means capital goes up, or it has a credit balance. Okay, here's two terms that we're going to talk about. Income and expenses. You probably know the common term, but there's sort of a more technical term. But you also need to remember this. For income, debit means credit means to increase. For income, credit means to increase. And an income has a credit balance, not a debit balance. The expenses is the opposite. Debit means it has a debit balance, and debit means to increase an expense. So it took me, when I was in college, I took probably 10 accounting courses. And it took me a while, but after a while, you just memorize it. You know how you memorize anything else, the alphabet or songs, anything that you've memorized. You just have to commit it to your memory. Assets have a debit balance, liabilities have a credit balance, capital has a credit balance, income has a credit balance, and expenses have a debit balance. So I told you assets are always on the left because they're on the left side of the equation, right? And so they have a, what kind of balance? What means left? They have a debit balance. So this says assets have debit balances. So earlier you learned debit means left. Hence an asset account, such as, what does asset mean? Something you own, like cash, accounts receivable, inventory, equipment, they should have debit balances, okay? Let's review. What side do assets go on in the T account? On the left side, because assets are on the left side of the equation. Do assets have a debit or a credit balance? They're on the left, so they have a debit balance, because debit means what? Debit means left. Okay, so we talked about assets. Liabilities are always on the right side of the equation. You can see at the bottom. Liability balances should be on the right side of the accounts. So liabilities have what kind of balance? A credit balance, because credit means right. So here we see that credits are on the right. And do you remember what is liability? Accounts such as liability is something we owe. So such as accounts payable, because we owe it. Notes payable, that means like, let's say I tell someone, oh, will you sell that to me? I will give you a note and I'll pay it off in a year. That's a note payable. Wages payable, you might owe the employees. You might owe interest to somebody. Though now I'm going to give you a tip. And they don't have this for receivables, but they have it for payable. If you see payable, it always means it's a liability because you owe it. You have to pay it. So if you see payable and I say, what kind of account is mortgage payable? Then you would say, oh, payable, that means it's a liability. And they have a credit balance because they're on the right side of the equation. So what side do liabilities go on in the T account? Right, because liabilities have a credit balance and credit means right. Do liabilities have a debit or credit balance? Whoop, I just said it. They have a credit balance because liabilities are on the right side of the equation. Credit means right. Okay, so we're going to do the same for capital. Capital is basically the same as liabilities because they're on the right side of the equation. And so the balances always go on the right. Now, if it's a corporation, then the stockholders' equity is the capital. If it's just a business, like I'm also a real estate, I'm a real estate agent. And so if I want to figure out my equity, do you remember how I figure it out? I take my assets, which could be bank account, my automobile, what people owe me, and I subtract anything that I owe. I might owe taxes, I might owe credit card. The difference is my equity in my business. Because I don't know if you remember, I said if you took all your assets and you sold them and you paid off all your debts, that's how much equity you would have. So equity has a credit balance because it's on the right side of the equation and credit means right. Okay, so we're going to demonstrate how a double entry with a transaction. Let's assume you're opening a new company with two partners and you're each going to invest $50,000. So in your mind, think of a friend that you have and you want to go in partnership, but you each have to put in $50,000. So you just won the lottery. So you have QuickBooks and you have a bookkeeper, how is she going to enter this? The company receives cash, your company, and so your bank account went up by $100,000. Well, your equity also goes up by $100,000 because, how do you know? Well, assets have to equal liabilities plus capital. So the only asset you have so far is $100,000 because you each put in 50. So, and you don't owe anybody anything. So your capital has to equal $100,000. Let's review. Can you guess which two accounts are affected by the transaction of each partner contributing $50,000 to the company? We just said it. Cash, you put it in the bank, right? You each wrote a check. You gave it to the bookkeeper. It said, put this in the business account. So now how much is in your bank account? $100,000, right? So your bank account went up by 100,000. So what other account went up? Was it liabilities? No, liabilities means what you owe. So it has to be your equity went up by $100,000. Cash is increased, capital is increased. Now, this might sound like I'm repeating the same thing over and over. And the reason I actually am is that you have to hear things several times in order for it to sink in your brain. And you're learning a lot of terms right now. I read this thing and I always told my students jokingly that I saw this study on the internet, which is always right? That you have to hear something 16 times before it transfers over into your long-term memory. Hopefully, it won't take you that many times. Okay, so this is how you record the transaction we just talked about in T accounts, okay? So we debited cash because debit makes cash go up, right? Because cash is an asset and it's on the left side of the equation, so it has a debit balance. So cash goes up when you debit it. Remember, owner's equity went up by 100,000. So on the right side of the T account, and your equity went up by 100,000. Now, some students sometimes get mixed up because they think if something goes up, something has to go down. No, that's not true. Because you could see right here, debit meant my bank account went up by 100,000, and credit meant my equity went up by 100,000. And the reason they both went up was because you're bringing in cash from an outside source, not a business source. You are each contributing money. You're each contributing capital. So that's why they both went up. Okay, so I told you that revenue and income are sometimes used interchangeably. Revenue technically means money earned by the company as a result of its normal business activities. Now you might say, well, why do you have to say it like that? Well, because sometimes you'll receive money, but it's not earned. Let's say, well, it's like when you each put in 50,000. The company didn't earn that money. That's why it went to capital. It did not go into the revenue account. Revenue is money earned by your company, like you did a service, you sold somebody something, and it's a result of normal business activities. And you might wonder why you say normal business activities. It's because sometimes you could earn money that's not a normal business activity. Sometimes you can, like if your bank account is drawing interest, that is not called revenue because it's not money earned by the company as a result of its normal business activities, which might be consulting with somebody or selling candles or something like that. That's normal business. This was just you earn money because you had money in the bank. That is not called revenue. It's called income. Income means everything earned by revenue and everything earned by other sources. That's income. Okay, an expense is a cost incurred in connection with normal business activities, and it's paid to a vendor or an employee. That's a cost. If it was, and And again, you have to say normal business activities, because let's say your company let's say one of the partners needed a loan and you give him money, you paid money, right? That's not an expense. That is a loan, because it's not a cost incurred in connection with normal business activities to a vendor or employee. A vendor would mean, like, let's say you made candles and you went to a wax company and you had ABC Wax Company. That's a vendor. And let's say you also had to buy the wicks, so you bought it from another vendor. But also, let's say you have employees. Those are also expenses called salary, right? If you pay a vendor, it's an expense. If you pay an employee, it's an expense. If you loan money out, not an expense, because that's not a normal, it's not a cost incurred in connection with a normal business activity. So that's a definition of revenue and expense. Okay, so some of these questions are a little tricky. If I pay rent to the building owner, is that an expense? Yes, that is actually a cost incurred in the normal course of business. And I did say vendor, but we're calling the landlord a vendor because you have to have somewhere to put your people for the business, right? So that's an expense incurred in the normal course of business. So rent is an expense. If a person pays me, let's say it's an employee, if he pays me back money for money I loaned him, is that revenue? No, it's not, because we did not earn the money in the course of business. We had loaned it money and he paid it back. Now, if I was a loan company, then that might be different if that was my normal course of business. But let's say I make candles. No, I just loaned him money because he was having a hard time and then he paid me back. When I received the money, it's not revenue. It's actually called paying back a loan from the employee. Okay, let's say I am a bookkeeper and I have a client and he gives me a fee because I did some work for him. Is that revenue? Yes, because it's a fee received in the normal course of business. So a fee is income, which is revenue. Well, a fee is revenue, which is income. And so yes, that's revenue. Okay, this one's tricky. If I buy a car, is that an expense? Well, you are buying it in the normal course of business because you need a car. However, in accounting, this mostly has to do for tax purposes, but the bookkeepers, that's how they do it, is it's an exchange of one asset for another. If it's over $2,000, you don't expense it. They call it expensing it if you're paying less than $2,000. You don't expense it if you buy a thing like a computer or a car. If you bought, $5,000 in wax, yes, you would expense that. But this is really an asset. And the difference is, and you won't learn it in this class because depreciation is in a more advanced class. But the difference is you depreciate a car and you depreciate a computer, but you don't depreciate wax. So anyway, I'm just letting you know that there is a difference. What you do is, if you bought a car, it's exchanging one asset, which is your cash. Let's say you took a wheelbarrow of $30,000 or you wrote a check. You gave it to the car dealer and they gave you an asset. So in that case, automobile account goes up, cash goes down. So that's not an expense. Okay, so revenues go on the right side because revenues increase capital. Now, this is a little tricky concept. Just remember, revenues increase capital. So let's assume a company provides a service and bills a customer $400. Let's say you're a bookkeeper and you bill a customer $400 and they have to pay you in 30 days. They don't give you the bank account, the money in the bank right away. So revenues go up. Revenue is a sale. Sale is the same as revenue. And so that causes your equity to go up because if you look on the equation, your bank account went up $400. So your capital or your equity also has to go up by $400. So an asset will make capital go up. Okay. I mean, not revenue. Revenue where you receive 400 and make your asset go up, then that also makes capital go up. Okay. So revenue and the T accounts. Here's what occurred when we just made that last sale. You are a bookkeeper and you did a service and he said, please bill me, I owe you $400. So in the T account, you debit accounts receivable because this is one that you just have to remember. I don't know why my students get confused. An accounts receivable is an asset. It's like if an IOU piece of paper, that's your asset. They owe you $400. So if you kept track of everybody's on a piece of paper, that piece of paper would be an asset. And you performed a service, so your sales went up. Your service revenues went up $400. Sales is the same as service revenues. Okay, expenses decrease owner's equity. Just like we said, revenue, if you make a sale, it increases it. Expenses decrease owner's equity. So let's see. Let's go to the example. So you're going to pay $150 for advertising materials for your company. Let's say you are the bookkeeper, but you said, oh, I need clients, so I need to advertise. And so you you go to, let's say it's the internet and there's a company that will advertise on the internet and they charge you $150. And it's places where companies go to find a bookkeeper. So the $150 is an expense because you paid out money and you didn't get an asset back. So that's an expense. So at the bottom, this is how to show you that capital is decreased with an expense because the expense made your bank account go down by $150, right? So your assets decreased by $150. Well, if you looked at the equation, if your asset decreases by $150, what else has to happen? Your capital has to decrease by $150. So the net result is that an expense will decrease capital. So this is how you show it on a T account. Your cash. So I don't know if you remember, debit means make an asset go up. and cash is an asset, but we're not debiting it. Our cash didn't go up, it went down. So what do we have to do? Credit cash, our bank account. Credit means make this bank account go down. What is the other account? Advertising expense. Now, I don't know if you remember, it was a little while ago and I said you had to memorize it, but debit makes expenses go up. So our advertising expense went up. And let's say the next month you had to pay $150. Well, now you owe $300, right? And say the next month it went up. So see how expenses go up, up, up. It's the expense account goes up, up, up. Okay. Let's review. Do sales increase or decrease equity? They increase it because if you do assets equal liabilities plus capital, and capital is the same as owner's equity, your asset went up by the amount of the sale, so your capital goes up by the amount of the sale. Why do expenses decrease owner's capital? This is a little more tricky to answer. Because you paid money, right? So your bank account went down. So if your asset goes down, then your capital has to go down. If you remember the equation, assets equal liabilities plus capital. If assets go down, which is your bank account, capital has to go down. That's why expenses decrease capital. And remember, capital and owner's equity, they're interchangeable. Okay, these are just some tips that I memorized over the course of my career when I was a financial manager for 25 years. You will have to think of your own. There will be videos we'll watch that try to give you little tips to do it, but these are just some basic ones. When you receive cash, you debit cash. When you pay cash, you credit cash. It's the opposite, right? And cash means any bank account. It could be checking, savings, money market, could be any bank account that has money in it. Okay, when revenues are earned, you credit the revenue account. Revenue is the same as sales. When you make a sale, your cash goes up and your revenue goes up. So you debit cash and you credit sales. When you incur an expense, let's say you go to and buy paper at Staples. So what happens is if you paid a check, your bank account goes down. Well, you always say the debit first. That's just how you do it in accounting. So I was going to say you credit your bank account, but I'm going to say the debit first. Okay. I am going to debit capital. Debit means make capital go down. And I'm going to credit my bank account. Credit means make my bank account go down. And if you remember, they don't both, you don't have to have one go up and one go down. Sometimes they both go up and they both go down. The only thing is your debit has to equal your credit. Okay, so we're moving on to a next section from T accounts. These are called journal entries. They're basically doing the same thing as T accounts, but they look like they're in a different form. And these journal entries are a lot like what you will see in a journal entry in QuickBooks. Let's say you were the accountant, you make the journal entries, Now, an accounts receivable clerk usually doesn't make journal entries or accounts payable because they usually only work with paying bills or taking in money. But the bookkeeper, the account has to make journal entries. And this is kind of what it looks like at QuickBooks. So when we get to the journal entry part, which is it for a while, this is what it will look like. But journal entries are the same principle as using the T accounts, but it's more in a horizontal form and you can fit more. So normally my class would have watched a video about this and they would have gotten a background, but we're going to jump right in. Okay. So here's the journal entry. City Express was paid for an ad placed in their newspaper on April 1st. They're looking for an assistant. So for a journal entry, you always write the date. And here's the detail. You always, I said it before, you always record the debit first. It's debit and then credit. That's just the way accounting goes. So we're going to debit advertising. Yep, over here on, oh, this is just a reference, journal entry reference. But you're going to debit, and you don't have to worry about that. Debit advertising, debit advertising. See, it's under the debit column. And you're going to credit bank account because advertising expense was debited, it went up. And your bank account was credited, so it went down. And then you just put the description right here. Okay, let's see another one. On April 2nd, a rent deposit was paid to the landlord. So we paid rent. I don't know why they call it a deposit. Rent was paid to the landlord for $1,000. Now this is an expense because it's in the normal course of a service in the normal course of business that we're paying for. And so we pay rent expense, we debit. Debit means make expense go up, $1,000. And does our bank account, when we pay rent, does it go up or down? It goes down because they take the money out of your bank account. And so it's under the credit column here. So see how it's sort of like a T account, but it's going this way instead of going this way. One more. On April 3rd, $110 was paid to this power supply company for the connection. They're just saying we're paying the bill. So our utilities account is an expense. So do we debit or credit to make the expense go up? We debit because debit makes expense go up. Remember I said you had to memorize it. So see here, debit makes this expense go up. And bank account, did our bank account when we wrote a check to the utility company, did it go up or down? Went down, right? Because they took our money. So we credit. Credit means your bank account is decreased. These are what are called journal entries. I just wanted to show you an example of journal entries. Now here's another video. And this lady shows how to do journal entries, and she explains it really well. It's 8 minutes. So if you wanted to watch it, this is in the student resources, okay? So we're going to do journal entries. That was for expenses. Now we're going to do sales, okay? Just for practice. This is giving us practice to get it in our mind how do journal entries work. So $850 of cash at checks was deposited because those were for the sales for the day, okay? So it was April 21st, and they're the sales for the day, and we are going to deposit them, okay? So what happens? First, we're going to do the debit. Now, our bank account went up, right? And debit means make an asset go up. So we're going to debit our bank account. And on revenue, what makes revenue go up? Debit or credit? Credit makes revenue go up. So people paid us money and our bank account went up. So we credited sales for $850. Okay, more sales on April 22nd. Our bank account went up, so we debited it. Our sales went up, our income went up, $980. And again, more sales. So our bank account went up $325 and our sales went up $325. So that's how you do a sales journal entry. Now, sales and expenses are all done in QuickBooks. It's called behind the scenes. So you're not going to see this until we get to journal entries because QuickBooks automatically makes the journal entries for you. But I like you to know what's happening behind the scenes because if you just stayed as an account payable clerk or an accounts receivable clerk, you would never have to know journal entries. But there will come a time where you want to be promoted to the supervisor, right? And the supervisor, the bookkeeper, needs to know how to make journal entries. So that's why it's good to know behind the scenes what's happening. Now, when we had paper and pencil, we had to do it this way. But with the computer, if you're accounts receivable clerk, you'll just see an invoice that you're making, sending it to ABC company that they owe us $500. Or if you're an account payable clerk, you will see an invoice someone gave us, you'll record it and you'll write a check and pay the bill. So you will never see the journal entry because you'll see a screen that does it all for you. But remember what I said, if you want to ever get promoted, you will know how to make journal entries. So that's why I'm just giving you a taste. You actually don't even have to memorize this till we get to journal entries. Okay, so this is assets. So $1,500 was paid. So this is a flour company, I guess. Yeah. And they paid $1,500 for stock. So their inventory went up by $150,000. Now, inventory is an asset. You own it. Remember, asset means you own it. So inventory is an asset, and it went up by $1,500. So you debited inventory. Well, did our bank account go up or down? It went down because we paid. Let's say we wrote a check and we paid for the flowers. So we credited our bank account. Then we went to Office Supplies Inc. and we went and we bought a desk chair. So we debit office furniture and we credit our bank account because we paid, right? And then IT Experts was paid at $145 to set up a new computer, and we paid them $350 for software. So we paid IT Experts, which is a technology company. Now this, I don't know if you remember, I mentioned debits have to equal credits, but sometimes it can be split. This is called a split transaction, but it still balances. So they bought plant and equipment. I guess plant means for your company, of $845. And they, okay, the asset here is a computer, not the software. Okay, so, and then they had a computer expense of $350, but they wrote one check to IT Experts. They wrote one check for $1,195, but it was for two items, right? It was for equipment and for software. So this is called a split transaction, but do the debits equal the credits? Yes, the debits equal the credits. They both equal $1,195. So your books are still in balance. Okay, we're going to do journal entries on liabilities. Remember, what are liabilities? Liabilities are what you owe. You owe it to somebody else. So Rose secured a business loan for $7,000. So did our bank account go up or down? It went up because they gave us $7,000 on the loan, right? However, the liability is the bank loan, and we have to pay back $7,000. So let's say we had to pay like $100 a month. Every month, the liability would go down. But right now, we owe them $7,000. And I did say if you see payable, you know that means liability. But sometimes it does not say payable and it is a liability. So you just have to know, what is it? Well, we owe it, so it's a liability. Okay, so on April 21st, Rose purchased vases from the vase company, and she said, please bill me. So she took in $250 of vases in her inventory because she's a flower company, and inventory is an asset, and she debited the asset because debit means make asset go up, and our inventory went up, right? But now we owe vase company. We owe them $250. And it's a liability. Whoop, here's the clue, payable. It's a liability. We owe it to them. And on a liability, credit means make liability go up. So the accounts payable went up by $250,000. Okay, so on April 30th, we made a loan payment. Remember I said if you make a loan payment, then your liability goes down. So this is an entry that shows your liability is being reduced. But if your liability is being reduced, well, what happens with your bank account? It goes down because you had to make a loan payment, right? You wrote a check to the bank. And so here's the entry. And remember, I said you always put the debit first. So we're going to put the loan. And, oh yeah, bank loan. It's the same, bank loan and loan. They should have said bank loan here. And $325. So do you remember debit makes a liability go down? So if we originally owed $7,000, now we owe what? $6,675. I don't know. My mental math. I rely on a computer now, so. But we owe $7,000 minus $325. So the bank account, it's reduced because we wrote a check for $325. And if you credit an asset, our bank account is an asset because we own it, then your bank account goes down. And so you credit the bank account. So now we're going to make some journal entries with capital and draw. So let's see. On April 1st, Rose deposited $3,000 from her personal money. Now remember, this comes from an outside source into the business. It's just like when we had the two partners and they were each contributing $50,000. And so the capital went up by $100,000. Well, Rose is putting $3,000. So first we do the credit, and the bank account went up by $3,000, right? Because she's taking money from her personal account and putting it in her business. So the business bank account went up $3,000. So if an asset went up $3,000, then the capital would go up $3,000. Okay. Next, this is the opposite. A draw, we haven't talked about this yet, is the opposite of contributing money to the business. It's drawing money out. And what a draw does the same thing as an expense. It makes your capital go down. Because let's say your bank account had $3,000 and Rose came in and took out $150. So we debited draw. What happened to your bank account? It went down, right? So we paid our bank account went down $150,000. What means make bank account, which an asset, go down? Well, credit. If you credit an asset, which is a bank account, it means make it go down. So our bank account went down by $150,000. Okay, now on April 27th, Rose took $90 to pay the vet. So this is something you normally shouldn't do. It's mixing your business money with your personal money, but it's not against the law unless it's like a corporation. But if it's just your own business, you could take the $90 and you could say, well, I'll just say it's a draw. It's like writing a check to myself for $90, okay? So draw went up by $90,000, so we debited it. And what happened to your bank account? Well, we wrote a check to the vet, right? So it went down by $90. So this is the journal entry. If she paid her vet, it's really a draw, okay? Time to review. If I make a sale and the customer pays me cash, so if I'm a candle company and you say, oh, give me a candle and I will, here's $20 bill, I'm paying for it. What is the journal entry? What are the accounts that are used in the journal entry? Well, cash went up, right? Because they gave you $20 and you're supposed to put it in your cash register, right? And sales went up because you made a sale. And credit means make your sale go up. So this is another time where cash went up, sales went up. They both went up. That's possible, but the only thing is you have to debit one and credit one. You can't debit both and you can't credit both. If I go to Staples and I buy a computer, let's say it's $3,000, and I tell them I want to charge it, put it on my bill. What two accounts are used? Well, do our bank account go down now? No, because we charged it, right? So it doesn't affect cash. So what accounts does it affect? Well, your equipment went up, right? And equipment is an asset. So debit means make your equipment go up. So we debit equipment. And a charge account is a liability. So we credit what we owe Staples, the liability, the credit card payable. We credit because credit means make liability go up because now we owe them, right? We owe them $3,000 for the computer. Okay, this is the last section. The first section was T accounts. Well, first we explained accounting principles, but then we did T accounts. Then we did journal entries. Now what we do is we need financial statements to see how healthy our company is. Let's say I'm the candle company and I took in sales of 10,000 and I had to pay 8,000 in expenses to make that much. Well, yes, my income is bigger than my expenses. So that's good. That's healthy. Maybe I wanted to make more, but at least I didn't lose money. But let's say it's the opposite. Let's say it's your candle company and your expenses were 10,000, but you only took in 8,000 because it was a bad year and people only bought 8,000 of candles. Well, you had a loss, right? Because you had to pay out more. And you might say, well, how could you do that? Well, remember, she put in $3,000 of her own money. So that's how she could pay her bills. Otherwise, she couldn't pay her bills. So there's two statements that show your health. The balance sheet has your assets and your liabilities. So it shows, if like when I was a financial manager, I would give a balance sheet to the owners and they would say, oh, we have a lot of cash at the bank, right? And then they would also say, oh, but why do we owe so much to the vendors? I think they're charging us interest. Will you pay off these liabilities? So when they looked at the balance sheet, they saw our assets, they saw our liabilities, and then at the bottom, they saw how much equity that we had. An income statement is a different statement. It shows how profitable you are. Did you make money? Like what I was just talking about. Did we have more income than we had to pay out? That is the income statement. Now, the income statement has three names. You'll hear it like this. Sometimes they'll call it an income statement. It's also known as the profit and loss statement. And sometimes it's called the P&L. So if you ever hear P&L, that means profit and loss. Balance sheet basically only has one balance sheet. Okay, so there's a video that will be in the resources that you can watch about financial statements. And I think it would help you if you wanted to know more about it. But we're going to talk about the balance sheet right now. And there is a section in the QuickBooks talking about balance sheets. So you will have to know this, but I just wanted to let you know what's on the balance sheet and what's on the profit and loss. That's all I wanted to let you know right here. So the balance sheet records a company's assets, liabilities, and equity, which is the same as capital, right? And right here it says, as of a moment in time. And you might be like, why does it do it then? Well, because you have to say, well, how much did we have in the bank as of what? As of the first day of the month, as of today, as of tomorrow. So you always have to put one date that it's as of. So that's why they call it a snapshot as of that date. So let's say we're reaching the end of the month and I ran a balance sheet as of November 30th. And they always mean it's as of the end of the day because you're getting sales in and you're paying stuff during the day. They mean as of closing. And this tells me how many assets do I have? How much is in the bank as of November 30th? How much do I owe people as of November 30th? And then remember, assets equals liabilities plus capital. So the capital would be as of that time. So when you run a balance sheet, it always only has one date. And I'm stressing this because the income statement is different. The balance sheet, they call a snapshot in time. What do I own? What do I owe as of November 30th or whatever date? One date that you put. So here's an example of the balance sheet. Here's the assets. It includes current assets, which means things that could be liquidated within 30 days. Other assets such as cars, furniture, equipment. And remember, an accounts receivable. An account receivable is also an asset. And these are the assets. And do you see it's as of this date? And these are the assets. And then they're totaled right here. $61,000 in assets. Okay, these are the liabilities. Next. I owe on my car. I bought a car, but I owe on the loan. I owe on my credit cards. I owe a total of $10,600. So what is my equity as of March 31st? It's also known as capital. Well, since liabilities and capital have to equal assets, then owner's equity would be $50,400. That's pretty good equity. Okay, now we're going to talk about the income statement. The income statement shows how profitable you were within a certain period of time. So you always put the beginning date and the ending date. And so you could do it as of a year. Like, let's say my boss said, will you run me a profit and loss statement for last year? Well, what would be the first date? January 1, right? What would be the last date? December 31st. It would show all the income and all the expenses within those two dates. You don't always have to have it just for a year. You could have it for a quarter. So if it's March 31st and my boss says, will you run me a quarterly income statement? Well, quarterly. There's 12 months in a year. So a quarter of that is 3. So January, February, March is a quarter. So if I ran a profit and loss for a quarter, what would be the first date? January 1st. What would be the last date? March 31st. All the income and expenses paid within that time, that is the quarterly income statement. And like I told you, it shows how profitable the company did during that period. So you take your revenues, well, your total income, and you subtract everything that you paid out. And if it's a positive number, it is profit. If it's a negative number, they call that a loss. So this is the ABC company. Is this for a year or for a quarter? It's for the first quarter of the year. And the revenues were $145,000. Woo, that's a lot. And the interest was $165. So the total income was $145,165. Now, these are all the expenses, because if you see here, income minus expenses equals net income. I paid my employees $120,000. I had insurance, rent, advertising, auto expense. Now, this auto expense is not buying an auto. It means like putting in gas, doing a tune-up, because I don't know if you remember when we bought the auto, it was exchanging money for an automobile. But this is just the upkeep, the little, if it's under 2,000 and it's in the normal course of business, then you put it, you expense it. And telephone, this is when we paid our telephone bill. So our expenses were $128,150. And so if you take your income and subtract, our profit was $17,015. I don't know if that's a lot or a little, but that's what it is. Okay, we're going to review. Which financial statement is like a snapshot in time? Remember, it only has one date because it's like, as of that date, what are the assets? What are the liabilities? It's the balance sheet. If I make an income statement for the first quarter of the year, what dates do I indicate? What's the first date? If it's a quarterly for the first quarter, January, right? And how many months if it's for a quarter? 3 months. So January, February, March. So what's the last date? March 31st. So it'd be January 1 to March 31st. All the income taken in during that time, all the expenses paid during that time. What accounts are in a balance sheet? Remember? Now, I'll give you a hint. It is that equation that we learned a long time ago. Do you remember the equation? Assets equal liabilities plus capital. Well, those are the accounts that are in the balance sheet. Assets, liabilities, and capital. Which accounts are in an income statement? It's also called a profit and loss. Well, do you remember? You take the income and then you subtract any money you paid for the expenses and you get your what? Profit or loss. If it's switched, then you have a loss. The accounts are income and expenses. Yay! You're ready to start QuickBooks. So this concludes the video for learning. You learned accounting principles, the terms, like asset, what's an asset, what's an liability, what's capital, what is an expense, what is an income. And you learned about T accounts, and you learned about journal entries, and you learned about financial statements. That's a lot. That should be enough so that you can know what's happening behind the scenes in the QuickBooks, because there are sections that talk about that. And so you could come back and refer to this video. I also am going to put, in addition to this video, I'm going to put this slideshow so you don't have to listen to the whole video. You could scroll through the slideshow and to get to the part that you want. If you want to learn, say you want to just learn about financial statements, you could scroll all the way to the end because the financial statements are in the end. Okay. So that's it. And I hope you learned something valuable in this video.